Hi class. Today we're going to look at problem 10-6b, which is very similar to problem 10-6a in your homework. So if you want to follow along with me, I'm in the textbook on page 499, and incidentally I'm actually looking at the electronic text. And if you are using the electronic text, I think there's a misnumbering on it. Mine says P1-7b and it should be P10-6a. So you want to look for the problem that starts with National League gear. So if yours is misnumbered as mine is, just kind of try to find the problem with those wordings. So P10-6b says National League gear has two classes of stock authorized: 4% $20 par preferred and $5 par value common stock. The following transactions affect stockholders' equity during 2018, National League's first year of operations. So it's their first year of operations, so all of our beginning balances are going to be zero, which is something we'll need to know in the future. And then we have a list of transactions. The requirements are first to record the transactions, and then secondly, we are to prepare the stockholders' equity section of the balance sheet. So I've created a template that's very similar to your homework template. In your homework, you're actually going to have to put in your account names. I went ahead and put those in mine just to save a little bit of time. But we're pretty much going to go through the same process. So we have on February the 2nd, our first transaction says we are issuing 1.5 million shares of common stock for $35 per share. So when we issue this common stock, we are going to record in a couple different ways. First, we know that we're going to get $35 a share, and we're selling 1.5 million shares of stock. So 1.5 million times $35 a share is the cash that we're going to collect, and that's $52,500,000. So that one's fairly easy to get. The next thing we're going to do is record our common stock and our paid-in capital. So when we record the sale of stock, we record part of that sale of stock in our stock account at the par value per share. So our instructions tell us that our common stock has a $5 par value per share. And out here to the right, I've kind of typed out my calculations so that you can see exactly what I'm doing. So when we're recording the par value of our share, that amount is going to go in the account that is called common stock. So 1.5 million shares at the par value, which is $5 a share. If we do the math on that, we get $7,500,000. Now the amount that we're paid that's above the par value is what we call additional paid-in capital. So we're going to actually record the difference in the debits and credits here. You can use a plug to do that. That's $45 million. And that's the amount that it takes to get our credits up to $52,500,000, which is how much in debits we have. Now, if you wanted to do that mathematically, this would be the 1.5 million shares times the amount of cash less the par value you got. So it's 1.5 million shares times $30 a share, which is the amount that you were paid per share that's above the par value. So that is how you're going to record a sale of common stock that is made above the value of par. So the next entry, we're going to record a sale of preferred stock that is says issued 600,000 shares of preferred stock for $23 a share. And if we look at our instructions, it tells us that the par value of preferred stock is $20 a share. So again, we're selling some stock that is the sale is above the par value. So to get the amount of cash that we received, we're going to take the number of shares, which is 600,000 shares, times the selling price, which is $23 a share. So if we do the math on that, we come up with $13,800,000. And then we're going to do the same thing as we did before with the common stock. We're going to calculate the amount of the sale that was the par value and then the amount of sale that was in excess of that par value. So the amount that we're going to record In the preferred stock account is the amount of that sale that was at par value. So 600,000 shares times the $20 par value. We do the math on that. We get $12 million. And then our additional paid-in capital, again, to me, the easiest thing to do is just plug that number, which is $1,800,000, and that's the amount of that you need to get your credits equal to your debits. But again, that is the amount that's over par. So if you wanted to do that mathematically, it would be the 600,000 shares of preferred stock at the amount that's over par. So we paid $3, or we were paid $3 over par for that stock. So $3 times 600,000 shares would be $1,800,000. All right, and then on June the 15th, it says we're going to repurchase 150,000 shares of its own stock for $30 a share. So when we repurchase our own stock, we call that treasury stock. Now, the first two transactions are recorded in a similar manner. Whether they're common stock or preferred stock, we still are going to record a debit to cash, a credit to whichever stock account is appropriate, whether it's common or preferred. And then if the amount of the sale was over par, then we're going to record a credit to that additional paid-in capital account. But treasury stock is a little bit different. When we record the sale or the purchase of treasury stock, we just are going to record that at the amount that we paid. We don't do anything with par value in that case. So our treasury stock, we got cash of $30 a share, and we purchased, we paid cash of $30 per share, and we purchased 150,000 shares. So to record that, you're going to do 150,000 shares times $30 a share will give you $4,500,000 in cash that you paid. And we're going to record that amount in the value of our treasury stock that we purchased. So we're going to debit treasury stock for $4,500,000. The next entry is on August the 15th, and it says we are going to reissue 112,500 shares of treasury stock for $45 a share. So we are going to receive cash for all $112,500 of those shares, and we sold them for $45 a share. So here's the calculation I did. So if you do that math, you're going to get a debit of $5,062,500. Now we had a debit balance up here in our treasury stock account where we purchased that treasury stock. So we need to reduce that because now we don't have all those stock because we reissued some of those. So when we reissue treasury stock, we're going to take out of treasury stock an amount that's equivalent to the value of those shares that we put in. So if you remember when we put these treasury stock in that account, we recorded those at $30 a share, which is what we bought those shares for. So to take them out of that account, we're going to take them out at $30 a share. They went in at $30, they're going to come out at $30. So it's 112,500 shares at $30 per share, which is how much we purchased those for. And that amount is $3,375,000. And then we have a balance, an account transaction that's out of balance. So our debits don't equal credits. So when you do that additional paid-in capital, you can do a plug again. That's $1,687,500, and that's the amount that brings our debits and credits in balance. If you wanted to do that mathematically, you would take the number of shares times the difference between what you recorded them here at $30 and up here that you sold them at $45, so $15 a share. You could do the math and actually come out with the same thing. All right, so that's in August. We're going to go all the way to November the 1st, and we are declaring dividends. So it says on November the 1st, we declare a cash dividend on common stock of $1.50 per share and a $480,000 cash dividend on a preferred stock payable to all stockholders of record on November the 15th. So, and then it says, hint, dividends are not paid on treasury stock. Well, that makes sense because we own our treasury stock. So any treasury stock that we own, we're going to pay ourselves dividends on those. So the first thing we need to do is figure out how many stock were outstanding, issued and outstanding on November the 15th. That's the date of record. So to do that, we're going to have to come up here and see what happened to our common stock. So up here, we had 1,500,000 shares of common stock that were issued on February the 2nd. So I've just kind of gone down here and made a running total. So we had some issued to start with. And then nothing happened on the 4th with our common stock, or the 15th of our common stock. Oh, we did, I'm sorry. On the 15th, we repurchased some common stock. So we repurchased 150,000 shares. So I'm down here. 150,000 shares comes from up here on June the 15th. So I'm going to subtract those out because we repurchased those. Then down on August the 15th, we reissued part of those. So we reissued $112,500. So I'm still right down here in the yellow. So we're going to add those back to the amount that are outstanding. So if you take the 1,500,000 shares that were issued to start with, then subtract out the ones that we repurchased, and then add back in those that were reissued, you get 1,462,500 shares of common stock that are outstanding. So we need to calculate how much is the dividends for those common stock. And also we had a set amount of dividends on our preferred stock. So I'm going to have to scroll a little bit over here towards the right. So here's the calculation. We're going to take them 1,462,500 shares of common stock. Our instructions tell us that they paid $1.50 a share. So we're going to take the total common stock times $1.50 a share. And that'll give us the dividends on the common stock. But we also have to remember to add in that $480,000 of preferred stock dividends. So multiply out your common stock to find your dividend, add in your preferred stock dividend, and that amount is going to go over here in dividends. So that, if we do the math on that, is $2,673,750, and that goes in dividends. And we didn't actually pay those dividends yet, so we have a liability for that amount. So we're going to record that in dividends payable. And then the next entry, the easiest one we're going to do today, is that we're going to pay those dividends. So we have this amount as a liability in our dividends payable. So we're going to take that amount out of that liability account. So $2,673,750 out of that payable account. And it's going to cost us that much in cash. So we're going to credit cash to show that payment out of our cash account. So that finishes up all of our transactions. And now it says requirement 2, prepare the stockholders' equity section of your balance sheet as of December 31st, 2018. Net income for the year was $4,900,000. So I have, excuse me, I have a template that I've started with. So we're going to complete these sections of our stockholder equity section of our balance sheet. And so to do that, we're going to have to look at our transactions above. And remember, this is the first year that this company has been in business. So we had no previous balances. So at the start of the year, everything had a balance of 0, which makes it a little bit easier for us. So we're going to list out the values that we have recorded in preferred stock, common stock, and additional paid-in capital. So to do that, we're going to have to scroll up. We started with preferred stock, so you can come up here and look at what you have included in preferred stock. And we actually had only one entry that affected that preferred stock account, and that is right here. And that amount of preferred stock was a credit of $12 million. And we did nothing else with preferred stock in this problem. So we can scroll down here and put $12 million in our preferred stock. All right, so we have common stock at $5 up for par value. And let's see. Up here we had an entry to common stock for $7,500,000. Now you can scroll down and we're looking for any transaction that is recorded to the account common stock. And there aren't any. Now, I know that we had some treasury stock that we repurchased, but we are not including that at this point, because those treasury stock purchases and reissuances didn't affect the common stock account. They affected the treasury stock account. So we'll look at that in a few minutes. But for now, we only have one entry in common stock, and that was that first entry where we issued $7,500,000 in common stock. So we're going to put that there. All right, now the additional paid-in capital gets a little more complex because we had several entries that affected that account. So we're going to scroll back up and look for all the entries that affected additional paid-in capital. Now I have them listed here. I kind of cheated ahead of time, but we're going to go back up and look at those. So I'm going to start with our first entry, and here's the first one, additional paid-in capital of $45 million. So there's one. We have an additional paid-in capital in the next entry of $1,800,000. And then we're going to scroll down a little bit more. We get all the way to August right here before we see another additional paid-in capital of $1,687,500. And then the next two entries were dividend payments and declarations, and neither of those affected our additional paid-in capital. So if you look at my list down here, you'll see the $45 million, the $1,800,000, and the $1,687,500 that came from that reissuance of treasury stock. So if you add those together, you're going to get $48,487,500, and that's the total that we put in that account, additional paid-in capital. So I'm going to record that, because that's actually the balance in that account. And we get a total paid-in capital of $67,987,500. So that's all of the capital that we had that was paid in. Our retained earnings, we're going to calculate that, and I've got the calculation over here. So remember, retained earnings from past years was 0 because we weren't in business past years. So that part's pretty easy. We're going to take the retainings from past years and add our net income for this year, and the problem just gives us that amount. It says net income for the year was $4,900,000. So we're going to add our net income. And we subtract from that the dividends that we distributed. So we paid dividends, and when you pay dividends, those dividends come out of your retained earnings account. So we're going to subtract out the amount of dividends that we paid. And you can come back up here to those calculations, and there's the amount of our dividends that we paid. Actually right there. So we subtracted out the dividends. So we've got prior year retained earnings plus our net income for this year. Subtract out your dividends from this year, and this gives you the ending amount for retained earnings, which is $2,226,250. And then we have treasury stock. 37,500 shares of treasury stock is what we have left at this point. So let's look up here at those treasury stock transactions. So here we've got where we, we purchased the treasury stock on June the 15th, which was $4,500,000 in that treasury stock account. And then the next entry that we have, we reissued $3,375,000 of that treasury stock. So when you're doing the calculation for that, and these are the only two transactions that affect that account called treasury stock. So you're going to take the treasury stock debit to start with. You're going to take away the treasury stock credit, which was the next thing that we had. And that amount we're going to put down here under treasury stock, which is we're going to actually reduce our stockholders' equity by that amount. So it's $1,125,000. So again, that is the balance in that treasury stock account from those entries above. So we're going to subtract that out because that's an amount that we still have in our equity section, in our equity accounts, in our transactions up here. So you'll notice all of the other equity accounts, common stock, preferred stock, both of those accounts had, they carry a credit balance. A treasury stock, that treasury stock account carries a debit balance because up here we had a debit there, which put that balance in treasury stock, and then we reduced it by this much, but we're still left with a debit balance. So that debit balance is going to offset those credit balances from our preferred stock, our common stock, and our additional paid-in capital, and that's why it's subtracted out here. So we had total paid-in capital plus our retained earnings less the value of our treasury stock that we're holding, gives us a total stockholders' equity of $69,088,750. So that is actually the end of that problem. So that's shouldn't be too difficult for you, and this is the only problem for the week. So I hope this is helpful.